Everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's a moment of both pride and genuine interest, genuine pride, to be bringing in some of our friends from the International Monetary Fund for the release of their major new study on international taxation. We're going to have a presentation by Michael Keane, who was the lead author, but this, of course, is a team effort from the Fiscal Department at the fund, led by Vitor Gaspar, and many distinguished colleagues, some of whom are with us today. We're fortunate as well to have with us some major discussants in true intellectual horsepower. Mindy Herzfeld from University of Florida, Levin College of Law. Mindy is as well the contributing editor and columnist for Tax Notes International and is Alpha Counsel at Ivins, Phillips & Barker. And we're delighted to have back our recently non-resident, but always in our hearts fellow, Gary Hufbauer, who some of you will know had been beating the drum here at Peterson to try to get some convergence between the American and the rest of the world's international corporate tax for some time. And so it's a very exciting moment for us to address this issue, or rather to provide a forum for the fund to address this issue. We are especially delighted and honored that the managing director of the IMF, Christine Lagarde, will open the session. I will not delay getting to Christine because whenever the managing director of the fund puts her or himself behind one of their staff reports, it obviously attracts attention, gives weight, gives impetus. But that has never been more true than when Christine Lagarde does it. And that is obviously a reflection of some of her immense personal qualities, but it's also the team at the fund we've been proud to partner with through recent years has been out there with her and her leadership's encouragement, making clear statements and getting ahead on some of the biggest issues in the international sphere. And we've been very fortunate in our ongoing enjoyment of partnership with the fund to support them when they rolled out their big initiative against energy subsidies, which is a huge aspect for emerging markets, with the efforts on growth in Asia, with an emphasis on womenomics in Japan, female labor force participation in Korea, and throughout the region. We had a joint conference with the Asia Department a year and a half ago, and Madame Lagarde used that occasion as well to beat the drum on female labor force participation. And we've been very proud to interact repeatedly, not just with the research department, not just with the Asia department, but in particular the fiscal department under Vitor Gaspar in recent years. I will simply say that it's time, and the fact that the fund is coming out gives you the real message. It's time we do something about multinational corporations and global taxation. The current system is not merely unpopular. It is an affront to the legitimacy of taxation around the world. It is an inefficient system. It is distortionary. It interferes meaningfully with revenue collection. And it leads to, rather than cooperation, less than optimal forms of competition between governments, particularly some small governments who understandably seek to take advantage of the system. And it requires an international coordinated effort to make that happen. What the fund is proposing in their study, which we will allow Mick, Vitor, and others to present, is not going to be the last word. I wish it were, but it's not. But it is, with Madame Lagarde's backing, the next step in moving this debate forward and getting us to a fairer and frankly more just as well as more efficient global tax system. And in that light, I am delighted that the MD, Christine Lagarde, is here to launch our discussion. Madame Lagarde.
Thank you so much, Adam, and good afternoon to all of you. It has been too long, Adam, since I last visited and we discussed some really substantive issue, and it was just before you took the helm at the Institute, and it's very, very nice to see some some familiar faces and some good friends that I miss actually for some of them, all of them, I should say. And I would like to really commend you at the Institute. We need the Peterson Institute, and we need forum where we can debate with a high degree of engagement, not only intellectual issues, but intellectual issues that have many practical consequences. And clearly you're doing that at the best, I would say. Now, I would like to say a few words, which will be, as a reformed lawyer that I am, in the format of a disclaimer. Because to be honest, I'm actually a frustrated tax lawyer. I've always had the highest regard in my profession, which was the law, for tax lawyers. I've always thought that they were the most sophisticated, the most complicated in the way in which their brain was organized. And I've always been extremely impressed with the way in which they can bring together accounting, economics, the law, and the rationale and the reasoning that lie behind the construction, the legal construction that we operate under. So it is with huge credit to be attributed to the team. So under the leadership of Vitor Gaspar, Mick Keane, well known to all of you. I'd like to mention Vicky Perry as well. I don't know if Vicky's in the room, but one of the lead architects as well, together with Mick, for the paper that was recently published, which is really a landmark paper trying to embrace not just the nitty-gritty details, that's not the point of this paper, and I'm sure you will be talking much more than I could about it, but which looks at the general principles and the macroeconomic consequences of some of the work that is being proposed. So, the issue today is international corporate taxation. And it was Albert Einstein who once said, "The hardest thing in the world to understand is the income tax." He also said, "I can fix anything except the madness of man." And I'm not suggesting here that the corporate tax lawyers are mad, however intelligent they are. But it is probably possible to actually create a corporate tax system that better reflects the changes in the global economy. And I believe that we need new rules in this area. Why? I will mention 3 reasons, actually, why we believe that it's necessary. First of all, there is a basic public perception and public opinion that large multinational companies pay little tax. And that has contributed to, at least in part, the breakdown in trust that we see throughout the global economy. And it has led to political demands for urgent action. There might be a bit of an oxymoron between reforming a corporate tax system and urgency, but I will leave it to the panel members to actually debate that issue. So let me highlight the reason why we believe that a new approach is urgent. First, the ease with which multinationals seem able to, if not avoid completely, at least minimize their tax burden through some tax optimization schemes that lawyers are very familiar with. And the 3-decade-long decline in corporate tax rates clearly undermines faith in the fairness of the overall tax system. So that's reason number 1. Reason number 2, the current situation is especially harmful to low-income countries, depriving them of much-needed revenue to help them achieve higher economic growth, reduce poverty, and meet the 2030 Sustainable Development Goals, which, under the leadership of Vitor Gaspar, our Fiscal Affairs Department is very attentive to actually figure out and identify in terms of estimate, which are just amazingly high. Advanced economies have long shaped international corporate tax rules without considering how they would affect low-income countries. IMF analysis shows, for example, that non-OECD countries lose about $200 billion in revenue per year or about 1.3% of GDP. Do you want me to start all over again? No. Okay, good. All right. Or about 1.3% of GDP due to companies shifting profits to low tax locations. Now, these countries, and we have approximately 48 of them, those low-income countries do not sit at the table where those debates are taking place. They're not members of the OECD, which is the reason why we believe that the platform for collaboration on tax, which is a joint effort between the IMF, the World Bank, the OECD, and the United Nations, is actually the forum, when it is up, running, and doing so smoothly and efficiently, will actually the ideal place for them to actually meet also what has been designed and what has been prepared in other forums. Third reason, an impetus for rethinking international corporate taxation stems from the rise of highly profitable, predominantly technology-driven, digital-heavy business models. I can start all over again. Technology-driven, digital-heavy business models. Why do I mention them specifically? Not to single them out like it has been the case in some European countries as well as Australia, for instance, most recently in order to respond to the political demand that was out there, but simply because of two reasons. One is, and you will see a very fascinating study that will be published at the time of our annual spring meetings that are coming up in 2 weeks' time, where we study the corporate power that has resulted from consolidation and the impact on the markups and the tax position that they have, which is really a very interesting phenomenon which has repercussions in terms of tax burden, tax optimization schemes. So that's reason number one. Reason number two, because of this, I repeat, technology-driven, digital-heavy business models, the old concept that we have lived upon for so many years and decades of the permanent establishment clearly is no longer relevant for many of those activities. Because we see, obviously, when we follow the revenue that are generated and the profits that have to be located somewhere, that there is a disconnect between actual place of activity, creation of value, delivery of value, and those permanent establishment or physical location whereupon tax, and corporate tax in particular, can be levied. So this in turn has sparked fairness concerns, as I mentioned earlier on, and countries with many users or consumers of digital services find themselves with little or no tax revenue from these companies. And that's the reason why you're seeing in various places around the world, and surprisingly so in Europe, this invention of new systems that are targeted at those digitally based companies, not only the GAFA, but quite a few others. So clearly, as this system is undesirable and not particularly efficient, we need a fundamental rethink of international taxation. Yet this means that countries must work together, and making progress requires coordination among all and in the right direction. That's where efficiency and time pressure are going to be at odds. It is difficult, but it's probably possible. The primary vehicle for coordinating multilateral work on international tax is clearly the OECD's inclusive framework, which now includes over 125 country members. This is impressive progress on multinational participation, but vulnerabilities remain. There are nearly 200 countries around the world, and we're still short of quite a few. So what is the role of the IMF in all that? I believe that we have a role in helping countries craft a solution that offers stability and that fully incorporates the interests, in particular, of developing countries. New IMF research published a few days ago analyzes various options in the context of 3 key criteria. Better addressing profit shifting and tax competition, that's criteria number 1. Overcoming the legal and administrative obstacles to reform, criteria number 2, and ensuring full recognition of the interests of emerging and developing countries, criteria number 3. And we believe that all 3 criteria have to be taken into account when testing the various alternatives that are being laid out in various corners. So how can we at the IMF best help? We can certainly provide a forum for good, honest, creative thinking around those topics, and we have unbelievably talented experts to address those issues and monitor those debates. We also give technical support on tax issues. We do so to about 100 countries every year. And we also have expertise to assess the economic impact of tax reforms, and that is critically important. Because the traditional, I'm sure some of you are experts and tax lawyers. We tend to look at the small details, the nitty-gritty aspects, the possible shortfalls, the loopholes, and the actual coverage. But the macroeconomic consequences of what we're doing on a universal basis in order to see where the chips fall, who bears the burden, and who has the benefit is something that certainly economists are more than welcome to also participate in. The third aspect of our support is that we have a near universal membership, which gives us an understanding of the particular problems facing developing countries in particular. So, I'm not going to say much more because clearly the panel discussions is going to be far more interesting than whatever words of introduction I can give at this point in time, but I would certainly like to leave with you the fact that the IMF is absolutely committed to those issues and committed with this universal membership perspective that we have, which leads us to consider not just where value is originating, but also where value is distributed and where loopholes can actually be facilitated and created. With that, Adam, I would leave it to you. I suppose you're going to be introducing the panel. Thank you so much.
Thank you, MD. As we said, as is always the case at Peterson, and we're grateful for the partnership with the IMF, it is the substance, the practical analysis that ultimately matters. I'm very fortunate I did not do quite enough justice that our lead speaker on the substance today is Michael Keane, who has loyally and substantially contributed to the IMF's Fiscal Affairs Department as Deputy Director since November 2007. He is also previously a noted academic, at Professor of Economics at the University of Essex, visiting professor at Kyoto, widely cited author in these fields, and of course has contributed to some of the technical assistance and country-specific work as well, along with his colleagues in the fiscal department. Our format will be as follows. Michael will present the study in brief, not too brief, but not too long, just right. We will then call upon Professor Herzfeld to give some initial reactions from her perspective, and then Gary Hufbauer from his. Then we will follow that with Vitor Gaspar from the fund, who of course is not just director of the fiscal department, but a variety of positions, as he modestly puts it, at the Banco de Portugal, and including as Minister of State and Finance of Portugal towards the tail end of the crisis. He will give a bit of a response, and then we'll ask Mick and all the panelists to come up for an open, on-the-record discussion with all of you. Thank you for joining us today. Mick, over to you.
Thank you so much. Thank you, Adam. Thank you, Managing Director. So my happy task is to get the discussion going by talking through the high points of the paper that we've recently released. Where do I point this?
Press down on the little...
Oh, okay.
You might have to turn it on. There's like a switch
On the left? Oh, okay. Wow.
Yeah, okay.
Brilliant. Okay, the main obstacle's out of the way now, so I can get going. So my talk's very straightforward in structure. I just have 2 parts. I'll say a little bit about the current state of the international corporate tax system, and then sketch out some of the alternatives that we and others have been thinking about. I should say that we think of this as, from the fund's perspective, as something of a follow-up to a paper that we issued in 2014. And I think what's striking is really how much the world has moved on since 2014. I think that at that point, some of the things we were talking about, giving some taxing rights to destination countries, market countries, were seen as, if not lunatic, at least heretic or impolite. But now they've become really very much the standard fare of international tax discussions. So it really is a kind of a very exciting time to be thinking about these issues, if we're interested in those kind of things. But it's really, I think, quite a significant juncture that the world is now at, and which the fund is trying to help steer in a good direction. So let me say a little bit then about where we are in terms of the international corporate tax system. Both in terms of process and also in terms of substance. In terms of the sort of process side of things, the last few years have seen, in many respects, quite remarkable progress on aspects of multilateral cooperation on tax matters. Most notably, many of you will know of the G20 OECD-led project on base erosion and profit shifting, which began 2013, reported in 2015. This essentially was explicitly a firefighting operation. It was not intended to change the basic architecture of the international tax system, but more or less to fix some of the most egregious forms of tax avoidance that were out there. And it addressed 15 areas, set out to address 15 areas of these kind of concerns, reached outcomes, action plans, really for 14. There was one that I will come back to that was sort of left over, no consensus could be reached, but there was agreement on the 4 minimum standards of tax design and a variety of more aspirational goals in relation to international taxation. And now that is all at the stage of implementation through the inclusive framework that the managing director mentioned. One thing I will note about the project was it had something of a banner, which the managing director alluded to at the end. And the banner was, we want to tax where economic activity occurs and where value is created. And I think we'll come back to this point about the idea of taxing where value is created, because I think it's proved much easier to figure out where value is not created than to figure out where it is created. But I'll maybe come back to that. And within the European Union, we've had the Anti-Tax Avoidance Directive, which was a kind of a close cousin of the BEPS outcomes. At the same time, however, there have been some quite notable, essentially unilateral actions, beginning with the diverted profits taxes of UK and Australia in 2016, which were very much in the spirit of BEPS, but was seen as being introduced, seen by some as being introduced in a kind of unilateral fashion. Importantly, and really critically, I think, to this debate, we had the US tax reform of 2017. Of course, the headline from that was a reduction in the federal rate from 35 to 21%, but in many ways, the most profound aspects of that were structural issues, structural aspects of the treatment of international income under the US tax reform. And those, I think, are really, it's not a phrase I like, but if there are ever game changers, I think some of those international aspects that we'll talk about were. And at the same time, we've had, as Managing Director mentioned, various actions and proposals on some kind of tailored, ring-fenced digital taxation of various kinds, with actions, some measures being adopted in countries, others being proposed, notably within Europe. And some of the result of this kind of spate of essentially unilateral actions, some of which do challenge established norms of international taxation. Some of these measures, for example, are seen as potentially inconsistent with tax treaties, in some cases with WTO rules. So in some sense, although, as we say in the paper, it would be premature to talk about this being a time of tax wars, I think it's fair to say that tensions have really risen to a higher level than they've been for many years in the tax area. So that's where we are. What are the issues that we, the fund, sort of see as important to carry on worrying about? Well, issue one is, I think, the continued opportunities for profit shifting, that is, for companies to manipulate where their taxable profits appear, to have them taxed at a lower rather than a high rate. The table, probably don't need to look at the numbers too much, these are estimates of the revenue lost as a proportion of corporate income tax revenue collected in the G7 countries from various studies. You can see that actually they vary quite substantially, sometimes even in sign, which is partly saying that we don't know still all that much about the extent of profit shifting. Still some more work to do there, and I leave it to you to figure out if these are big numbers in the wider scheme of things or not. I'll come on to later the fact that they are bigger numbers when it comes to developing countries. So as I mentioned, the BEPS project was aimed at the most egregious ways in which companies might shift profits. It's too early to tell what the impact of that will be. Of course, all these figures are for a pre-BEPS world, so we don't know how or whether they will change. But I think it's generally recognized, I think, that many of the underlying problems of the underlying architecture that BEPS didn't try to change remain. In particular, managing directors mentioned permanent establishment. Let me mention another one, which is the arm's length pricing, difficulty with arm's length pricing. So the basic idea here is that under the current system, the idea is you look at a multinational, you look at all the entities, the subsidiaries and so on within the multinational, and you allocate profits to each entity separately. Well, to do that, you need to have a way of valuing transactions between these companies. And how do you do that? Well, the principle generally applied is arm's length pricing, which is the idea that you should price these transactions for tax purposes at the prices you think independent parties would have agreed at. Now, that gets pretty hard to do in a world where intangibles are increasingly important. They're very hard to value. Great asymmetries of information between the owner of the intangibles and often the tax authorities. An example I give here is, well, this requires, for example, some view about how you allocate risk within a multinational. With all the financial transactions going on, which entity within the multinational is bearing the risk? Well, when you think about it, basically that doesn't make sense as a question, because the risk is borne by the group as a whole, not by any entity within the group. So you can see there are some basic, some fundamental problems with arm's length pricing, which are mitigated by BEPS, but I don't think anybody would claim that they're eliminated. Whoops. Oh, have I turned it off as well? No. There we go. Second issue. What did I do?
That's if you take too long to figure it out, the monster comes.
Oh, my Lord. Now I'm even more nervous that someone's going to creeping up behind me as well as possessing this distinguished audience. So where was I? Tax competition. Well, the BEPS project didn't really address this question of tax competition. The idea that when countries try to make their tax regimes more attractive than others, maybe at the end of the day, we end up doing each other more harm than good, and we suffer collective harm from that. Of course, we can, and the charts on the left, the one at the top is basically showing that within the G7, tax rates have continued to fall throughout the BEPS process. The chart at the bottom, you just see, you can guess that's declining rates of corporate tax. You probably don't need to see the labels to see what's going on there. Of course, there is an issue as to whether we think tax competition is good or bad. Some people think it's a good thing to discipline governments. Others would say, well, particularly in a world where we're struggling to maintain revenues, particularly in low-income countries, maybe if we want to constrain inefficient government spending, there are better ways to do it. A further concern, I think, is that potentially BEPS may even make tax competition worse, intensify competition for real capital, because essentially you're closing off all these avoidance devices governments can use in order to attract tax base and capital. So now what have they got to do? All they've got to play around with are the kind of core parameters of the corporate tax system. So maybe things will actually get worse. Let me just pick up the third bullet there. One of the responses to these difficulties is the suggestion that, well, you can only qualify for a particular low tax rate in some country if you prove you have real substance there. There are employees there, or there's investment there, or there's something going on. But of course, if you ask a multinational that's about to save several $100 million by locating employees in a particular jurisdiction, they will say, how many do I need to put there? So there's a clear, and I think Itai has called this the bourgeois theory of value, isn't that right?
Bourgeois labor.
Bourgeois labor theory of value. So there's an issue with the continuation of tax competition. As we've heard, we're particularly concerned with these issues for developing countries. The chart illustrates the point the managing director was making. If you look at the left, and if I look at the left and can read it, that's the losses, our estimated losses from profit shifting in dollars. And you can see it's much higher in the blue OECD countries than in the orange non-OECD. But if you look to the right, where we're looking at percents of GDP, it's much bigger in the developing countries. Now, I think probably we would say now these estimates are rather on the high side. But nonetheless, I think all the work that's been done since we did this exercise has tended to confirm that as a share of GDP, this is more of an issue for low-income countries than it is for high-income countries, hence the concerns the managing director was emphasizing. There are some key areas of concern in developing countries, which we talk about a little bit in the paper. They are vulnerable to abuse of treaties that allow people to root income in ways that minimize withholding taxes, interest stripping, use of interest deductions to move to essentially take deductions in high tax countries, receive the income in low tax countries, all these problems of transfer pricing, that is implementing the arm's length principle, and a more complicated issue of offshore indirect transfers, which is to do with the complicated ways in which companies can realize capital gains in order to avoid paying capital gains tax where perhaps the underlying asset is located. That perhaps is of interest just to say a little bit about that, because it illustrates, I think, a point the managing director was making. That was the offshore indirect transfers was an issue that had been prominent in IMF technical assistance, was not included amongst the BEPS action items. I think it's fair to say we essentially pressed this issue, and as a consequence, we've nearly come out with a toolkit jointly with the OECD to help countries navigate around these issues. So we think that's quite a nice illustration of the point, how the capacity building that we do at the fund can help inform the standard setting work. Of course, let me just say a little bit more about the vulnerability. It's not just a matter of the revenue at stake being larger for low-income countries. They're more reliant on the corporate tax as a share of GDP. They get somewhat larger share of their overall revenue from the corporate tax in high-income countries. And you can say, well, if that corporate tax revenue went away, what else have they got? They've got the value-added tax, but the value-added tax is often under a lot of pressure in these countries. Income tax, well, the income tax isn't really very well developed. Customs, well, we're trying to reduce customs revenue, if anything. So they have fewer places to go as well if the corporate tax were to wither away. They have clearly the capacity constraints are an issue. This is a very complicated set of issues. They have many issues to deal with. They can't devote all their resources to international tax issues. And of course, there are also long-standing concerns in relation to how you allocate taxing rights between what we might loosely call source countries, which low-income countries tend to be, and residence countries. Typically, as a generalization, low-income countries are not the headquarter country of many large multinationals, which gives them a rather different take on the game. Oh, he's going to come for me again, this guy. Oh, no, here we go. Yes, I'm getting the hang of it. There's a whole set of issues around digitalization. Now, this slide could probably keep us going for the whole afternoon, so let me just be somewhat brief. So of course, there's a lot of concern with the growth of the digital giants in the tax area. We can ask, well, what's actually new about them? Some people say, well, what's new is that they can do business in a country without much of a physical presence. Well, that's also true really of any kind of exporting activity. But nonetheless, there's a general sense that this has reached this kind of activity has reached a quantitative level at which it becomes a real issue. There's also an argument that it's a new kind of business model because the users are really part of the business. So when we click on our favorite search engine or post pictures of the latest meal we've eaten for some reason, we're actually creating value. We are co-contributors to the business offering. And that's why we get these things for free. We're part of the business model. And the idea then is, well, you're like a producer. When you click and so on, you're actually a little bit like a producer. And so by standard norms, you might argue that the country where you're located should have some taxing rights. But that's very different from how we do things under the current norm. Hence the proposals for these kind of digital service taxes, essentially taxes on various sources of revenue that these kind of search engines, social media, intermediation services generate, or some of the revenues they generate. For the longer, those are kind of turnover-based taxes. For the longer term, there's talk of moving towards a wider definition of a permanent establishment, or some way of sharing what we call residual profit. I'll come back to that later. But I think the point I also want to make here is that, I should have said, this is the one area, I mentioned that the OECD had 15 action areas. This is the one area where they have not reached a consensus. The work is still ongoing. And the idea is now to come up with a report for 2020 that ideally would be a consensual solution. But what's interesting is that this report, I think the focus is no longer just on these digital issues. It's become all the other 14 action items and several more as well. This has become really the whole debate that I'm about to launch into. And I think the point I would make is that, going back to something I said before, where this digitalization debate has ended up is to me kind of emblematic of where this taxing where value is created slogan has left us. Because You know, we can all agree, we can all nod our heads and say, of course, that's what we want to do. We want to tax where value is created. But when it comes down to figuring out who's going to get the money, we may have different views about where the value actually is created. But let me then spend, if I may, the latter part of my talk saying, well, what are the kind of alternatives that we and others think about? And firstly, what are the criteria by which we're going to judge alternatives? And there I think we have a difficulty because I don't believe we have established principles for international taxation as firm, for example, as those we have when thinking about trade. We have free trade as a benchmark. Even in domestic tax matters, we have some fairly well-developed principles that people would agree on for good tax design. We have really very few, if any, in relation to international taxation. We have a notion that if their companies are earning rents, that is, if they're earning profits in excess of the minimum they require, then they should be taxed somewhere, but that's more or less it. So what we do pragmatically, breaking down the criteria the managing director mentioned a little bit, and finally, we look at how vulnerable is the system to profit shifting, how vulnerable is it to tax competition. Some people would insist on adding the word damaging tax competition to recognize some tax competition is good. Issues of ease of administration and compliance, legal obstacles, and how suitable they are for low-income countries. One point to stress here that I won't have time to go into very much is that your assessment on these things can be very different depending on whether you're talking about one country adopting these systems or essentially everybody. And I'll perhaps touch on that if I have time right at the end. But just then to go through some of these schemes. So one set of schemes we label under minimum taxation. This is very much, I think, inspired by the US tax reform, informally the Tax Cuts and Jobs Act. What does this mean? This has kind of two bits. One is the outbound. So sitting, for example, in the US and looking at the multinational headquartered in the US, looking at its income from abroad. And the idea here is that the residence country is going to tax the foreign earnings that the company has if the tax levied by the foreign countries is below some minimum. So the US, for example, is going to make sure that there's at least some minimum rate of tax paid on US multinationals' earnings abroad. And that, to cut a long story short, is one of the novel elements of the US tax reform, that it does something like that. The other aspect, the other kind of leg, is the inbound leg. So now you're looking at investment, say, in the US or in a low-income country, and your concern there is that there may be some profit-shifting payments going out of your country somewhere else. Someone's shifting profits out of your country through interest payments, abusive transfer pricing, whatever. The inbound minimum tax essentially puts a limit on the deductibility of these kind of payments. So what are the attractions of this approach? Well, one is it helps to reduce profit shifting, because if you're going to end up in the US paying this tax anyway, there's not much point moving it around abroad. Reduces it, doesn't eliminate it. May mitigate tax competition because, for example, now suppose you're a foreign country and you want to attract this investment, say from a US company, by offering a low zero tax rate, say, well, it doesn't do the US company that much good because they're going to be paying tax in the US anyway. So there's less point for you having try to attract profits in that way by engaging in tax competition. Attraction is also relatively close to current arrangements. To some degree, it can be done with minimal coordination. And we do, in our work, find some benefits, particular benefits to these schemes from low-income countries from this minimum tax on inbound investment. On the other hand, it can get, as we see, I think, with the US reform, it can become a very blunt instrument. It can unduly discourage investment. And there's a question of, well, if you're going to have a minimum tax, what rate should the minimum tax be set at? So that's one scheme. Another scheme that you may recall from discussions, I guess, 2016, is the destination-based cash flow tax. This is a scheme that was proposed by the House Republicans in 2016, I think. What does this mean? So the cash flow part means you expense investment rather than depreciate it. By the same token, you no longer get interest deductions. You just write off all investment when you make it. The destination bit means, like a VAT, you exclude exports. They're not included in the tax base, but you do include imports. You may get to deduct them, but in some sense, they cross the border, they pay tax. If you're a business, you can then get to deduct them. What are the advantages of that? Well, again, this one we think, or is generally seen to be pretty robust to profit shifting, because, for example, think about profit shifting through interest deductions. Well, under destination-based cash flow tax, you don't get an interest deduction, so that won't work. Suppose you try and play around with the price of your exports. Well, that's not going to work either, because your exports isn't taxable, and it's going to be essentially neutralized in the importing country as well. So it's very robust against profit shifting, quite robust against tax competition, because at the end of the day, tax sticks where the final consumer is. You can't move final consumers around, so there's really not much point in trying to engage in tax competition through that route. And it falls, essentially, it's a tax on rents. Just to make one point, because the analogy that this is partly like a VAT is something striking, and people remember that. But it's important also to remember it's not like a VAT, because in that you also get a deduction for wages. So this isn't kind of like a regressive VAT. We can think about who bears the burden, but it's not. It's very different from a VAT in that wages are deductible as well. Some of the challenges, well, it's others in the room can speak to this more than me. It has some potential risk with the WTO, has refund issues, because essentially, if now with immediate expensing, companies, for example, that simply invest and then export, they're going to be entitled to a large refund of the tax they've been charged on their inputs. Third one we look at is formula apportionment, which has been very popular with civil society. This essentially says, well, let's forget about all this allocating profits across entities. Let's just look at a multinational, figure out its profits on a unitary basis, and then share that out across the countries where it's present by some kind of formula. Could be the sales you have there, capital employment, whatever. And this is, of course, is how the state-level income taxes work in the US, and how the provincial level corporate taxes work in Canada. So it's kind of natural to think this may be the way the world is going. Of course, this eliminates profit shifting, because now you're just looking at the multinational on a unitary basis. You're not trying to parcel up its earnings. But at the end of the day, everything, the thing to remember here is that everything depends on what you put in the base. Developing countries, for example, don't necessarily gain, it seems to us, unless, for example, you give a large weight to the number of employees. There's still a risk of tax competition. Tax competition doesn't go away, because you might want to attract the formulae, the weights that go into the formula to get a bigger share of the base. And all kinds of game playing complexities can go on when, for example, you simply operate this within some regional units, say European Union. Of course, I should have said that, in the European Union, the long-standing proposal for a common consolidated corporate tax base is for a tax of this form. And then the last one that we look at, it's quite a lot to absorb, I'm afraid, is what we call residual profit allocation. So residual profit allocation is really a hybrid. How does this work? This basically says we're going to look at the multinational, we're going to look at all its activities, all its functions, and we're going to allocate to those functions what we would call a routine return. Now, you can think of that as a normal return on investment. Now, papers have been written and will be written about why normal and routine are different, but for today, let me get away with thinking of routine return as a normal return. So the idea is that where stuff happens, that country at least gets the normal return. That then leaves you, possibly, with a residual, a kind of an excess of what's called the residual profit. And the idea is that that part you allocate by some kind of formula. Could be by sales, much like formula apportionment. Could be by sales, some measure of income attributable to that jurisdiction. So that's why it's a hybrid. You use arm's length pricing or some simple formula to allocate the routine profit. The rest you allocate by formula. Which is kind of, in a sense, what it's saying is, well, we know arm's length pricing may work pretty well for these routine functions, but there's all this other more complicated stuff to do with intangibles and so on. Let's just find some way to share that out. And of course, there's an active debate on what weights you should use for the sharing out, but maybe I'll put that aside for the moment. What's nice about that? Well, it at least assures, if countries were to adopt this, it at least assures source countries get to tax the routine return. Now, that may not sound much, but on our preliminary estimates, that would give them, many countries, more revenue than they get at the moment. There are various qualifications to that, but we shouldn't assume there's no money there for many countries, maybe do more than there is at the moment. It's also less remote from current norms because we keep the tax lawyers employed on the arm's length pricing side of things. So everybody gets something out of this one. It's probably a little bit more complicated than formula apportionment. The other interesting empirical fact that our initial results suggest is that, well, where are these residual profits? Well, they're very largely, on our estimation, in US headquartered firms. Those results are pretty, they're fairly Beyond that statement, the results are pretty fragile. I think that's a fairly robust finding that we have. And so that brings me to my conclusion. So what we have in this, again, you'll find this in the paper. This is a kind of a heat map of the pros and cons of the various schemes under the criteria that I've mentioned, where, of course, green is good and red is bad. You'll quickly look to see if there is any unambiguous winner, and the answer is no. We're not endorsing any specific proposal. And in fact, all of these things you have to take with a grain of salt, because even within, there's so much, even within, an item in one of the items in any row, there are so many varieties of how these schemes may develop that it's very hard to reach general conclusions. So we'll think of this more as very much a general impression of how we would see these schemes, what their relative strengths and weaknesses are. And also, I think, just to mention again that this is assuming global adoption. The outcome can be very different with unilateral adoption. If one country were to adopt a destination-based cash flow tax and everyone else didn't, that country would become like a mega tax haven for the rest of the world. So we have to be very careful about the distinction between cooperative and unilateral measures, which I think brings us back to this theme of the importance of cooperation. So with that, thank you very much for your patience. Thank you.
Thank you. Thank you for having me here. I know you can't read that title. It says IMF policy paper, so you're not missing a lot. Corporate taxation in the global economy, and then it has my name. I get to comment on this paper from the status of as an observer, and so I don't have to adhere to any formal IMF line, and also I think I'm the only one other than Madame Lagarde, who's not an economist, on the panel to follow. So my comments will express both those perspectives. When I think why the IMF, why this paper is important, I think of a series of questions my 15-year-old son asked me a couple of weeks ago after I was had my iPad propped up on the console of my car as I was driving him to school so that I could be listening to the OECD consultation, which was running at European hour, Paris time, and not US time, so early in the morning. And as it was, I think they went on break as I was still driving, and he said, I don't understand how could an organization that's only got like 36 members write rules that are binding on the whole world. So I said, well, first of all, they don't write binding rules. And second of all, they've got, so I try to explain the inclusive framework to him. So I said, well, they've got a group that's 129 members, and so it's not really just 36 members. So then he said, and he's very into Model UN, so he's probably not your typical 15-year-old, but he said, I don't understand how could a sub-body of an organization have more authority than the formal organization. So those are questions from someone who spent a lot of time on international governance, international organizations. But I think those are if a 15-year-old is asking those questions, I think they're relevant, and it highlights really the importance of why the IMF had to write this paper. So I can say that. No one from the IMF can. Gary Clyde laughing there. So what I think Mick went through a lot of the context here. Obviously, BEPS is a big backdrop to what's going on. U.S. tax reform is another one. The digital focus. And the unilateral actions. But I think the big deal of what's going on now is the conversation over reallocation of taxing rights. And that's that the conversation at the OECD, which is formally titled Taxation of the Digitalization of the Economy, is really a discussion over reallocation of taxing rights. And there the IMF, I think, has a unique contribution to make, because that's a global conversation. That's not a conversation for 36 countries. So what do I, reading this as observer what the unique contributions of this paper, I think one really important one is that it starts to make an attempt, obviously not comprehensive because none of these proposals have been fully thought out, but really the first serious attempt to quantify what the impacts of these various proposals would be. You saw some of the charts that Mick put up, but I haven't seen anything like those before, and that's really the beginning of a process that I think needs to take place for the conversation until now over all these points, digital economy and reallocation of taxing rights, has been so theoretical and really difficult to come to any kind of meaningful consensus or work out details without some attempt at beginning to quantify impact. And so this paper makes an important step in that direction, really with rigorous economic evaluation. Again, the conversation at the OECD that I spent many hours listening to a couple of weeks ago, really so theoretical without any kind of rigorous economics involved there. And the other important point made by this paper is a full discussion of the different international organizations involved in this project, in this global conversation about how do we want to rewrite international tax rules, discussion about the roles of the different organizations, the strengths of them, and how they can complement each other into moving this conversation forward. The other thing I really liked about this paper was that it did provide a balanced assessment of the different proposals. I came away with it feeling, which I guess was where you wanted readers to come out with, a feeling that the IMF wasn't endorsing any particular one of the proposals, although I did feel that there was some remaining allegiance to the destination-based cash flow tax, maybe because that's the most economically pure of the proposals, but really willing to acknowledge the challenges that the proposal faced and continues to face. And the other obviously important contribution of this paper is the focus on low-income countries. And so there, even though the OECD does have this inclusive framework now, again, I'll go back to that consultation where I heard person after person stand up and say, oh, the OECD is the absolute right forum to have this conversation. The OECD is the right forum here. But as far as I can recall, really, none of those speakers were from a country other than Western Europe and the US. And so how do those voices get heard, I think, is a challenge and something that this paper tries to do. So some of what I think the paper does well is also something that one could critique about it, which is that there is no specific recommendation. And so if you're thinking about this paper as a way of moving the discussion forward, I think ultimately someone's going to have to make some recommendation somewhere in order to advance this conversation. And so I struggle with how the paper really moves the conversation, the theoretical conversation forward, given its impartiality and how strongly it came out and balancing its views on the different proposals. And then I guess what I struggled with was, and maybe I didn't read this carefully enough because I was told that the IMF was not trying to assume that tax competition was always harmful, but I found a very strong bias against tax competition, and I am, I guess, a little more neutral on that. I think there could be advantages in tax competition among countries. So I started with some context, but really I think it's important. We're spending this afternoon talking about corporate tax, but one of my other big takeaways from the OECD conversation, which isn't apparent in this paper because it's a more purely economics analysis, is this discussion about corporate tax is really just part of a larger conversation that's the backdrop for what's going on here, and that larger conversation has to do with the balance of power between countries. It's the conversation over immigration, which corporate tax, I think, is really part of, and also, of course, trade. It's part of a larger distrust of global business, and I think what this paper does, but really what many in this room or myself, corporate tax professionals are doing, and policymakers, I think, are often using corporate tax and discussions about the fairness of corporate taxation as a fig leaf to avoid perhaps discussing many of these harder issues, because of course, a conversation about multinationals not paying enough tax or where they should be paying tax is an easier conversation. Even though that's a hard conversation, it's still an easier conversation than the one about immigration, and the trade issues are also obviously challenging. And then there are the political economy questions, which I understand Vitor is going to talk about a little more. And I think the paper raises interesting questions here. There's this platform for collaboration on tax. It's not really clear how the different organizations have been or will be working together on that. I have questions about the continued relevance for the UN Tax Committee as part of this platform. There were a lot of questions raised when this platform came out with a paper a couple of years ago already, I guess, on the indirect offshore transfers, who was making the decisions there, what kind of, who approves a recommendation that this platform, in a paper that this platform may put out. And I think those questions, although the platform sounds like a really nice idea, there are lots of governance questions that are embedded in there. The other political economy questions are the pressures on multilateral institutions all over. The IMF is not exempt from that. Again, that's something I could say. And then I have this word up there that I really can't, I garble every time I try and say it, but I thought to me, it's a really interesting concept, plurilateralism. There, I got it. Which is a word I first heard a couple months ago on the radio, but meaning something less than multilateralism. And so the question for me is, how much, if any, does that concept of some subset of countries, but more than bilateral, does that have a role in advancing this corporate international tax conversation? And what is the right focus for developing countries there in terms of what's the right forum for them, and is corporate tax really the right focus? And there I think of some of the conversations that heard at side events at the UN where representatives of countries said, you're talking about corporate tax rules, and these rules are hard, but this is not what our politicians are focused on at all. And so is spending all this time on corporate tax really the right answer or the best answer for a lot of the low-income countries that supposedly trying to help here? Looking ahead, I think what are next steps here? Still a lot of work that needs to be done on quantifying these various proposals, and as they get further refined, I think there's even more work to be done. That work, again, has just started here. Obviously, just the tip of it, and impact on different countries is going to be significant. And so all the participants in the consensus building process at the OECD are going to want to see what the possible impact of the different proposals are on their tax revenues. That's a big deal. There's no certainty that this process of rewriting the international tax rules will succeed. And so one question is, what are the consequences of failure? I don't know the answer to that. I don't know that anyone does. But there's also a question of consequences of success. The IMF wrote a paper 5 years ago now on the spillover effect of profit shifting and base erosion activities. Did I capture that right? But every big change, or even sometimes small changes in the tax laws, have spillover effects. And so just thinking about, as important it is to think about consequences of failure, I think it's also important to think about consequences of success. What will those spillover effects be? And I think it's important there not to underestimate, the conversation until now has been so high level, thinking about what the impact will be on not just countries' tax revenues, but on taxpayer behavior, on cross-border tax cash flows, and investment flows are all really big deals. And again, could just small changes in tax rules could have big changes in incentives for taxpayers and behavior. And then another question I have is what kind of compensation will be offered? I don't know who offers it, but what kind of compensation will be provided for the losers? That could be countries, that could be different industries from possible changes. So that's it, and I look forward to our panel discussion.
Well, I have to start by thanking Adam for inviting me back from New Mexico and taking off my boots and putting on my tie. Well, I looked at this report and I wondered if it was missing a subtitle. And then after Michael Keene spoke, I wondered again whether the subtitle should be Save the Corporate Income Tax, Last Crusade. You know, the economic analysis, which I'm sure everybody in this room has been exposed to, is that the CIT, the corporate income tax, is the most distortive tax known to modern man. The welfare costs commonly exceed the revenue raised. So why would you ever want to save this? And this distinguished group of IMF authors obviously has read all this literature. They probably wrote some of it. But they only offer a very small genuflection to it in footnote 6, and I give it to you there. You'd hardly know that there were any doubts about saving the corporate income tax. And hasty readers and anybody listening to this remotely would think, gee, this is the project to save the tax. But I want to tell you there's good news, because if you read this carefully, there are hidden messages of a different character, and those are what I will emphasize. Okay, this, you can divide yourself in this world as to whether you're clapping your hands when you look at this or wringing your hands. If you're wringing your hands, you and I are not in the same universe. If you're clapping your hands, we should all go out and have a drink. This is really a great chart. It shows, thanks to profit shifting, yes, tax competition, yes, what has happened to this dreadful tax. It's basically gradually going away. It's going away faster in the advanced countries. Those are the blue folk, and slower in the low-income countries, but it's going away every place. So I'd say that's actually pretty good news. Not celebrated to the extent it should be in this report, but there it is. It's buried. Anybody who reads the report can see it. And further, if you look at the figure 4, both figures are from the IMF report. Figure 4 shows that to date, corporate revenue as a percent of total tax revenue has not actually fallen. In fact, in some countries, maybe it's risen a little bit, but it's about the same as it was way back in 1990, so 30 years ago. So, the world hasn't fallen apart the way many people who are concerned about tax competition were saying when I was in the Treasury, which is a long, long time ago. But Fred Bergson was there with me, and he remembers those stories. Okay, there are two bogus justifications for the corporate income tax, and there's one genuine reason. And the bogus number one is tax the fellow behind the tree, and if you're an MNC, a multinational corporation, you are really the person behind the tree. I mean, it's politically appealing, but what we know from looking at behavior in countries is that once you get those tax rates up there, where these proponents want it to be, you get all sorts of additional distortion on top of the regular distortion of a uniform corporate income tax. You get the subsidies, you get the targeted deductions, you get the pass-through entities, and Peter Merrill, who's here, is the pioneer in pointing out how these pass-through entities have, they take up half the U.S. business base. I mean, it's just enormous. And the political push behind them is very, very strong. But these other credits and subsidies for corporations, well, of course you want to tax the fellow behind the tree, but then you want him to set up the plant in your jurisdiction, whatever it is. So the higher the rates, the more you get this kind of secondary junk. So that's one bogus argument, which is, just because we know it's bogus, it's not going to go away, but it's gradually maybe getting less force than it once had. And then the bogus number two, which really is so, we misspelled it there. I was so agitated I misspelled it. But, some of these left-wing spokesmen these days do agitate me. Tax the rich. They want to tax the rich. Well, maybe we all want to tax the rich, but taxing business is not the way to tax the rich. I mean, it's just as simple as that. And we can go to a genuine socialist country, Sweden, and we can look at their tax system, and it has been looked at, and they don't tax business very much. They're in the kind of lower tax brackets, but they do tax the rich. And the way you tax the rich is the individual income tax. You can toss on a wealth tax. I mean, it's just intellectually simple. And raising corporate tax rates as a way of taxing the rich it's just fraught with all sorts of problems, which we've written about at great length, and I think everybody here knows. Now, the genuine reason is the last bullet there. I mean, it is so much easier to tax 10,000 business firms, whether they're corporations or business firms, or partnerships, whatever, than it is to tax 10 million households. I mean, taxing households is difficult, especially for lesser developed countries. It's even difficult for the US, very difficult for Italy. I'm sure the IMF knows that quite well. So, taxing through taxing business is, attractive from an administrative standpoint. Very attractive, and that was one of the criteria that the managing director pointed out. Okay, now let's give this report some bouquets. It does, a lot of work went into it, a lot of very bright people, and it deserves some bouquets. And the first one is this: beware of the digital tax system. Now, again, the way it was presented was kind of neutral, and I know the IMF wants to be very neutral, but this digital taxation, it's spreading fast. There have been papers written about it, including at this institute in Australia and other places. And this report illustrates the enormous contradictions which digital taxes will foment. It contradicts our international trade rules, it contradicts our tax rules, it's just straight out contradiction. And so for illuminating these contradictions, I give the report a small bouquet, maybe even a medium-sized bouquet. And I'm happy to say that this present Treasury has awakened to this issue, which is a big one. It's a big one for the US, and they've awakened to it. And here is a place where the US, the rules are working in the US favor. And I'm an American. They're working in our favor. And I don't see why we should just kind of give away the rules without getting something in return. And there's a lot we could get in return. that's what international negotiation is all about. But this whole BEPS report was basically a money grab on a handful of US corporations. That's what it was about. And that's what this digital taxation is about. And there's no reason why the US should want to concede that, especially when you look through the corporate veil and ask who owns those corporations, who's going to lose capital, capital gains, who's going to lose dividend income if these systems come about without any protest. I'm very happy now that the US is showing some spine and will protest. Then the second bouquet, and this was emphasized both by the managing director and Michael Keene, this need to hear from low-income countries. And, that is true. I mean, it has been an OECD club, no doubt about it. And the report deserves another bouquet for focusing on, these countries being present, not all of them, because how could you get a big enough room? This room would not be big enough for all of them, but get representation from low-income countries if there's going to be any redesign of the system. Now, there are two big bouquets. There are two ways to euthanize the corporate income tax. And this report lays them out, and I give it credit for that. But again, it does it in its nice, subtle IMF type of way, so many people will miss what's going on, but hopefully a lot of people will realize it. So one, you spread the adoption of minimum taxes, and they're spreading. Just like we're getting digital tax on the one hand, we're getting minimum taxes on the other. And two, you change the name and structure from CIT to DBCFT. And since that's 5 letters rather than 3, most people won't know what's happened. So let's go to euthanasia through minimum taxes. We've got several countries. You could add Sweden in there. It has a low minimum tax. It has a low corporate tax rate. I think it's about 20% or so. But we know that the well-known one. And then you have minimum rates on mobile income, both the stuff that flows out, that's the GILTI system, and then there's stuff that flows out from U.S. firms to abroad, and then the stuff that flows out from foreign firms doing business in the U.S. to their home base, that's the BEAT system. So we're edging towards that. And Michael Keene did do this much more elaborately than I, so I don't need to do it very much. But the advantage of the minimum tax approach, which is happening and will continue to happen, is that it fits within the existing corporate tax structure more or less. It's politically acceptable as an alternative to all these targeted subsidies which we have. My state of New Mexico, which was my home state and again is my home state, I mean, what are we doing? We're giving a tax credit relative to wages to firms which make their movies in the state, 25% of their wage bill. I mean, and we recently had this wonderful movie. It's a good movie. I enjoyed it. Clint Eastwood, I always enjoy what he does, called The Mule. Now, Clint Eastwood, why should 25% of his salary that it gets paid in some New Mexico account generate a tax credit? I mean, this is just, but this is where the system goes. And if we have minimum taxes, then you tend to not do that kind of stuff so much, and you discourage profit shifting. And the big disadvantage is that eventually, probably that figure 4, which I showed you, I'll just go back to it to refresh, probably this is going to curve down as we go into the minimum tax world. So then you have to think about how you're going to make up the tax revenue from economically sound taxes, but politically unpopular ones. That family, and that's the biggest growing part, or individual income taxes. Now, the next form of euthanasia is through the DBCFT. And this, as was said, reaches taxes on domestic activity, no tax on exports, no deduction for imports, and it essentially turns the CIT into a VAT, which, as we know from very solid econometric research is, all taxes distort, but it distorts the least relative to the revenue collected. If you keep the VAT rate uniform, which I know is hard to do, and so on, it distorts the least. And so you have this marvelous transformation, but keeping the corporate name, I don't know, somehow in it or whatever. You want to keep that transformation probably a political secret if you can. And it could raise serious revenue in the future, but there is a red line additional sentence which didn't get into this version, and I have to credit Will Martin for flagging this to my attention. Will Martin, I don't think he's here. He's written a really great paper on various aspects of the DBCFT, trade balance, exchange rates, et cetera. But the wage subsidy point is absolutely critical, which was a point that Auerbach originally made way back when it was coming into fashion and then has been highlighted. If you do the DBCFT and allow a deduction for wages, that's like a value-added tax with a wage subsidy. And when you do that, you don't raise any revenue. It's as simple as that. You do not raise any revenue. You have to pare back or eliminate that deduction in order to do the total transformation. And that is well amplified in Will Martin's paper, just came out recently. But for those who are short on reading time and can't get through an 86-page IMF report, which is what you have in front of you outside, just read these 6 pages, 25 to 31. Just read those on the DBCFT. Those are the most important pages in this whole report, and they are essential reading. And I have to say the authors missed this monumental piece of work, which Fred commissioned some years ago, but you can't expect busy authors to read ancient manuscripts. Now, we do have a couple of non-starters, which would, again, create balance in the report. Formula apportionment and sharing residual profits. I just have to say a few words on these. We've had decades in the U.S., and I studied this. We've had decades in the U.S. trying to reconcile formulas. We can't do it. And the Canadians, who are much more rational than we are, and there are fewer of them and fewer provinces, they can't do it either. So, where are the magic mushrooms that are going to have the countries in the OECD, much less the IMF, agree on a formula? And then this prospect of sharing residual profits. This is just mind-boggling, even though as clear a presentation as you could have, we had in the opening session, it's mind-boggling. And I just invite you to glance at IMF Appendix 10 and imagine ministers trying to agree on any sharing of residual profits. Thank you.
So thank you, and thanks, Adam, for hosting the IMF and the Fiscal Affairs Department once more. The theme that I want to cover is something that Mick did not cover on purpose during his presentation, which has to do with governance. How do we go about thinking about international tax multilaterally, and what are the routes for progress in the future? Specifically, what I want to do is I want to start by bragging for a couple of minutes. Then I will speak about the past of cooperation in international tax. And I will try to make a couple of points that may be relevant for the present. And then give you some indication of the way forward. I will not debate either what Mick has presented or what the discussants covered. I will leave that for the panel. So the bragging couple of minutes. Adam was very generous with my CV when he introduced me. But for the purpose of this session, I want to say that in the 1980s, in my own country, Portugal, I was a PhD candidate, and I was working for the Portuguese Tax Reform Commission. So that was the first assignment that I had out of the university, and I had the privilege to work with Roger Gordon and Joel Slamrud, both at the time from the University of Michigan, and I learned tremendously from that experience. My first papers were about tax. The first papers that I published were about tax, and just before joining the IMF, I was head of in Europe, we call this a high-level working group looking at the taxation of the digital economy for the European Commission. In that paper, we actually, I believe, were the first official group that made the point that given that all the economy was becoming digital, all the society was becoming digital, the approach to taxation in digital economies and digital societies had to be systemic. Trying to target a subsector would not work. Having what came to be known as a ring-fenced approach would not work. So why did I brag for a couple of minutes? Because from the viewpoint of the work on tax in FAD, my main contribution comes from recognizing how good Mick Keane, Vicky Perry, Ruth Demoy, Alex Clem, and other colleagues are, and keep out of their way. That's what I do in FAD. Now, having put that out of the way, I have quite a lot of experience in international negotiations, and I've been fascinated by how was it that it was possible to have a global agreement on international corporate tax. How did that come about? And that came about basically 100 years ago in the context of the League of Nations. That was one of the legacies from the League of Nations. The League of Nations was not the most successful organization. But in the area of corporate tax, the League of Nations did work with extremely good experts, and it was able to promote consensus based on a discussion of possible solutions to the problem that they were set to solve, which was how to avoid double taxation. And by having a technical consensus, they created a framework that then countries more and more started to apply. And on the basis of a distant descendant of the model for avoiding double taxation of the League of Nations, today in the world we have more than 3,000 double taxation agreements. Double taxation agreements started initially very much like trade agreements based on proximity and the need to not create obstacles to cross-border transactions. And so neighborhood was absolutely crucial at the beginning. And the concepts that underlie the current structure of international taxation still reflect those realities, which were dominated by trade in manufacturing goods, trade in physical goods. And so the idea of permanent establishment, the idea of accrued value, the idea of share of taxing rights between source countries and countries of residence of the taxpayers. Bear in mind that this conceptual framework is 100 years old. It's a framework that clearly did not anticipate the technology that we now have, that did not anticipate the way production and finance would be organized in today's world, that did not anticipate the potential of technology to solve taxation problems having to do, for example, with the sharing of information across tax authorities. So clearly, the international corporate tax system is up to a major rethinking. And my last point, what about the future? The future looks, in my view, extremely promising. Why is that? Because the inclusive framework of the OECD has agreed to look at the systemic characteristics of the overall tax system. They have accepted quite explicitly the idea that targeting a subset of companies, call them digital companies, is not the way to go. A broader approach is necessary. And they have put out a consultation document. The consultation period has finished in early March, in which they consider a set of proposals organized in two pillars: issues or challenges that were created by the digitalization of the economy and society, this is the first aspect, and the second aspect is some open questions having to do with the fight against base erosion and profit shifting. By having this broad agenda, they cover basically the ground that Mick has presented in his 5 proposals. Since it is a consultation document, there is not much analysis backing it, in particular not quantitative economic analysis like what Mick presented. But the point is that now, in May, the inclusive framework will be discussing a work program to be presented in the G20 in June. This is June this year. And the idea is to have an approach agreed by 2020. So, in 2020, 100 years after the start of the League of Nations, we have a chance at reforming the global international corporate tax system. It is an opportunity that should not be missed. And for that, the work of Mick and colleagues is, to my mind at least, an extremely useful and timely contribution. So thanks, Mick.
If I could ask our 4 speakers to make their way to the podium, where you have a lot of expertise in the audience as well as up here, and we're going to try to engage you all in a public on-the-record discussion, which might make the people who weren't named Gary sound a little less neutral than they did. As usual here at the Peterson Institute, we have a traveling mic up front in Jessica's hand. We have a standing mic at back. Given the nature of this topic, I'm going to loosen my usual injunction, which is you should pretend to be asking a question. You can make a point rather than a question, but it has to be brief. But please identify yourself when called upon. I believe this gentleman in the first row gets the first question. So identify yourself.
So my name is Itai Grinberg. I teach international tax at Georgetown Law. And my question is really for Mick. So first of all, I want to commend the IMF for putting out a paper by a multilateral institution that engages in serious, rigorous analysis and involves more truth and less truthiness. This is really helpful. Then as you look at the slide about what is good for developing economies, and as you read Managing Director Lagarde's editorial in the FT, there are two ideas that are kind of pushed a little harder than the others. Those are minimum taxes and residual profit allocations. I completely understand, thinking from the perspective of a developing economy, why one would want global minimum taxes, because they provide a floor for the corporate tax, which is important as a redistributive mechanism for developing countries, and that in some sense is a rejoinder to Gary. But then that brings us to RPAs. Residual profit allocations are administratively challenging for even the most sophisticated tax administrations, basically for the reason that in many circumstances, one must audit one multinational in a different country, outside the country of the tax administration, in order to determine whether the amount of tax that is being paid by that other multinational, unrelated, in the country of the tax administration is correct. Perhaps this could be done by the largest tax administrations and the most sophisticated governments on earth. But when the IMF suggests that that is one of the possible policy directions forward, I just ask, like, on whose behalf is the IMF speaking, and how we should think about that particular recommendation. And then I guess the next step is, if you think about going in that direction, as opposed to going all the way to a destination-based residual profit allocation, the problems get even harder. And so I just wonder whether the IMF wants developing countries to take on all the problems of unitary taxation and all the problems of destination taxation at the same time, or how we think about that IMF recommendation as contrasted with the minimum tax recommendation. So that's the question.
Thank you. Mick or Vitor, do you want to comment? And then if Mindy or Gary want to come in. Please press the button for the mic.
No, I think in terms of on whose behalf we're speaking, I guess we're speaking on behalf of ourselves and colleagues who've delivered technical assistance on these issues. I suppose on the RPA, I mean, I've always been, in mind, I'm not a transfer pricing guy, but I've always been quite attracted to the idea that maybe you can use these fixed markups, this Abayona sort of stuff. So people tell me that's going to be too crude, but I would have thought, at least in some cases, that would get you some of the way. But I guess it's also, and I found myself thinking a little bit also in terms of what Gary was saying about the adoption of the RPA, in that if you think about the US, in a way they've done an RPA. I mean, they've done their version of an RPA, it seems to me. They've said the guilty provision is basically equivalent to saying, if you have a routine return of 10% abroad, we're not going to tax it. At the residual abroad, we're going to tax at half the US rate. That is, we're going to allocate half of the residual profit to the US, which isn't a complete answer to your question about how we get to an RPA, but I think maybe it's relevant for this context, because at least that's saying, from a developing country perspective, you're freeing up, presumably, the 10% part to be taxed in the other jurisdiction. So I think I would defer to you on some of the administrative issues. So my colleagues may want to reply on that. But as I say, I'm always happy in many of the countries we work in with pretty simple things. So if we can getting away with a few simple markups, then that would suit me. But yeah.
Mindy or Gary, do you want to come in on this?
Well, I think there were a couple of interesting proposals that came out of the OECD consultation, which were simplified forms of the residual profit allocation. And so I would agree with Mick that some kind of theoretical residual profit allocation, but some kind of simplified methodology could work for developing countries.
But I think, I think we wouldn't claim it simpler. In that, I think we'd see it as adding some complications to formal apportionment. So it is, in some sense, partly also, I think, a political compromise as well, to say, well, we're not completely saying arm's length pricing and standard methods are useless, but we're kind of limiting their scope in some sense. But.
At the back mic, please.
Nicolas Veron here at the Institute and also at Bruegel in Brussels. My question is also to Mr. Keane, and I guess I'm not the only one who'd like him to perhaps have a bit of a reaction to what Gary's provocations. I know the panel has not been set up as having a discussion of the discussion, but still, it would be very interesting for me to know a bit what kind of reactions that elicited.
Yeah, I think if I can follow on, Nicola, and we encourage not just Mick and Vitor, but also Mindy. Gary has, I think, usefully drawn a line in the sand, and I think there are two key components to what he said. The first is that there is a school of thought that says corporate tax is just genuinely bad. Shouldn't we be getting rid of it? And second, that the Dimkust is preferable in a major way to things that are easier to pronounce. And so if we could get you all to comment on those, which I took to be the not-so-secret messages of Gary's comments.
Thank you. No, well, maybe it's strange. I actually agree with quite a lot of what Gary said. I mean, it is true that for the purposes of the paper, we couldn't write a paper on why do we have a corporate tax as well. We've already violated the theoretical word limits on the length of the paper quite a lot. But so, and I think that's why we just have a footnote, because we're just not going to enter into this, because I think it was a helpful, I think it's nonetheless a helpful question to say, well, given that, you know, if you assume we want to retain a corporate tax, here is a way we can maybe contribute to the ongoing debate. But I think many of the points you made are ones I would agree with. I mean, I think if I were to make a case for the corporate tax in the longer term, I think I would say, well, here is something we might be able to make into something like a rent tax of some sort, which we think of as actually a non-distorting tax. So when we think about the corporate tax, well, the rent, it's two bits, right? It's a kind of a tax on the return to equity and a tax on rents. And the rent part is non-distorting. The rent part, if we can get away with that, that's kind of ideal in terms of non-distorting. So I think part of what, and this is maybe reflected in some of the other papers we did on debt bias and so on. I think it is something that I think resonates throughout, as Vitor will know, I think throughout a lot of our technical advice, is we do often nudge countries towards, or, you know, our advice is often towards some sort of rent tax. And I think in that context, I think I'd make exactly the 2 points you made. I think when you think about developing countries, it's kind of different because they just need the money. And you can argue that many advanced countries, many advanced economies you talk about, if the corporate tax went away, well, it's not the end of the world. They can just have a proper VAT and, you know, sort it out. But I think many of the low-income countries where we're working, that wouldn't be the case. Maybe it's also as a footnote, and I don't know if you'd agree, I think we'd set aside, in a sense, we set aside another footnote, I think we probably have in the paper, is we don't talk about resource, we sort of set aside the resource sector, because that's clearly an area where, you know, you think of the corporate tax as actually the way you extract rents. But then, so I think I'd agree on, and I think I'd agree with your, in a way, your characterization of the destination-based cash flow tax. I think it is, in some sense, it is getting rid of the corporate tax. And I think that's, I mean, I don't have any, I might not express it that way, but I think I wouldn't have done it. But it's getting away with the corporate tax in designing what I would, you know, what many people would think would be an efficient rent tax. So I do think the corporate tax has potential as a way of taxing rents, and I think a lot of what we're talking about is nudging in that direction. So I think when I talked about the criteria, I think the first one I had was, well, we want to tax rent somewhere, and I think the corporate tax is still, in many respects, our best bet for doing that. But then I thought, I mean, and again, I think also the paper in kind of fundees, I think agrees with your point about the difficulty of getting the kind of agreement needed for formal apportionment or residual profit allocation, which we see in Europe already, I think, with the CCCTB. But then I do find quite intriguing this thought that I've just mentioned, that the US has actually just done an RPA in some sense, it seems to me. And then conversely, they're saying, you know, we're going to tax the 10% in the US at 25%. So it's not that far from an RPA. It's unilateral RPA. I can't quite write the story that then has everybody else joining in, but nonetheless, it's an interest. I think, well, it's an interesting observation. Whether it leads anywhere, I don't know. But
Thank you. Vitor, anything you want to add?
So one thing which is important in this paper is that we did not produce the proposals that we examined. Those proposals were being debated, and the fact that there is a almost complete overlap between our way of organizing the debate and the way it is organized by the OECD in the context of the public consultation really shows these are things that are going on there. Conceptually, I find it very useful to think about the destination cash flow tax as a rent tax, exactly like Mick was emphasizing. And you can, in a sense, perceive intuitively why it is a rent tax if you think that the tax rate is just the rate of participation of the state in the business endeavor. And so the state becomes a stakeholder in the project with a percentage stake that happens to be the tax rate. And that makes it very intuitive. That, as Mick was saying, is the most efficient tax possible. It is a tax on economic rents.
Mindy, do you want to comment on this?
Yeah, so I'm happy to be the non-economist here. And when I in my tax policy class, I go through some economics papers which talk about how terrible the corporate tax is in terms of efficiency, and then some other papers, mostly written by lawyers, but I think there are some by philosophers also. And I think those go to the reason why we're sitting here having this conversation today, which is public perceptions of fairness. And then at the end, I would take a vote in the class and I say, who thinks we should get rid of the corporate tax? And no hands go up. And that's because I think there's a real public sense that corporations are persons is too strong a word, but are entity, and that there is a fairness element to corporations having to pay tax. You talk about the economic inefficiency from here forever, but there's that public perception that I think is really, really hard to get rid of.
Thank you. Gary,
So many interesting points.
could you turn on the mic? Thank you.
So many interesting points. I agree with Mick that you can have a unilateral RPA for a country that generates a lot of technology. That's the US, that's the UK, that's France. That probably is in Bangladesh today. And so this unilateral RPA is very different than what is discussed in the paper and in Appendix 10 of kind of a multilateral agreement on the RPA, which I insist, as this gentleman indicated, is an absolute non-starter and a waste of time, though the mathematics is quite interesting. If I could just make a little comment to Mindy's comment on lawyers, well, I happen to be one of those, and I took those classes long ago and far away. And of course, lawyers, they have an interest in the corporate tax, just like my friend Peter Merrill. I mean, that's how they make their bread and butter. So, why would they want to get rid of it? But here's the real issue. Look at these pass-through corporations. I again refer to Peter, who's a real pioneer in this area. Pass-through business entities. We have 6 in our tax code. I don't know about other countries. Who in your class wants to tax partnerships or LLCs or their law firms, LLPs, at a business tax rate? None of them would want that. So this is just ignorant self-interest at work.
Before we transition to a perhaps different topic, I would just point out that not all economists are this type of economists, just as not all lawyers are that type of lawyers. So if you were to go back to the event we held in this room a little over 2 years ago on the DIPCA, there were some of us, myself included, who are not the geniuses that are public finance economists, but are simple-minded macroeconomists. And for macroeconomists, it sometimes seems like these discussions about ideal efficiency are actually second order small, despite footnote 6. And that some of the things that Mindy refers to actually feed back into overall revenue, overall balance of the government in a material way. And so, again, I'm not saying this settles the issue. It's not as elegant theoretically, but just as we should allow for some variation among lawyers, we should allow some variation among economists as well. There are things that are actually can be argued are more important than elegance and tax efficiency. They're worth thinking about, but they may not be the only thing. Oh, that got some response. So if you all could either line up behind the tall man at the mic, or you'll be next. The gentleman at the mic, please.
Yeah, Jacob Kierkegaard here from the Institute. Well, first to Gary, it's a pleasure to hear that your time in the West hasn't dimmed your thought that all tax rates should in principle be zero or paid for by future generations. But question about the digital tax, because it seems to me that that's really where, you know, the rubber hits the road on this whole set of issues and where it becomes operational. Because the reality is that we have, as has been alluded to, a digital tax targeting clearly a specific sector, now legislated in at least 4 major European countries, or partially legislated: the UK, France, Italy, and Spain. I believe Austria is also there. And it's also the case that in the event that there is no solution to this or agreement at the WTO in 2020, as Vitor mentioned, this will undoubtedly become an EU proposal. So my question is, one, what do we do about that? But secondly, I would like the panel's sort of feedback. If we take a broader view and realize that digital tax really isn't just a digital tax, it's really a big data tax. Right now, big data is concentrated in just a few select companies, but in the sort of 5G Internet of Things type of world that we're likely headed into, Huawei or not, that's not going to be the case. So my question is, if we get to having the big data in every sector of the economy, potentially monopolized by a limited number of companies in each sector, not necessarily Americans always, quite likely, but what do we do about that?
It's like first Vitor, then Gary.
If I may start, the issue is broader, Jacob, than what you imply in the following sense. The digitalization of economies and societies has created dynamics that undermine fundamental cornerstones of the system of corporate taxation as we know it. The concept of permanent establishment based on the definition of a significant economic presence in a physical way is something which has become obsolete in very large segments of our economy. The importance of intangible assets, which dominates the investment of the largest corporations in the world, creates fundamental challenges to the application of the arm's length principle, the idea that one should try to value transactions inside a multinational as if they were carried out by independent parties. And that basically means that the system as we know it is not working properly. And as time goes by, it will be working worse and worse. So there is an element of urgency, quite apart from the political salience of these considerations, that really pushes in the direction of a solution. If one goes targeted and sectoral, one ends up with a list of corporations which are predominantly US corporations, as Gary was saying, and clearly such a evolution, if it were to be pursued unilaterally by other countries or other groups of countries, would create problems for a multilateral solution. That's why many of the examples that you listed have a clause that, although legislated, this targeted tax will only enter into force if no multilateral agreement is reached. What is in the pipeline is a relatively non-ambitious goal, which is to have an agreement at the level of G20 about the way to go forward, how to organize the process of multilateral negotiations. Given the importance of these dynamics for our economy and our societies, I think the incentives behind finding a multilateral understanding are very strong. So I really think that we should make the best use of the year that we have until now and mid 2020 to make sure that there is a agreed path forward. The alternative is very unpalatable.
Well, Jacob, as you know, we wrote a long paper on this to crystallize the three objections to the way digital taxes are spreading. They violate the existing permanent establishment concept. They violate the non-discrimination because they all have these very high floors below which taxes are not imposed, and they violate the the WTO declaration, not legally enforceable, but it is a declaration still on the books of no duties on digital flows. So those are pretty big violations. Now, what Vitor has said about the history of the league, I think that is very instructive and very worthwhile, and I applaud the IMF for holding this new forum, but it has to be seen as a negotiation. You start changing those things, and who loses? Well, I think the loser should get something in return from other countries. And there's a lot that this administration, but we'll leave this administration to one side, the previous administration, the Obama administration, and the previous one to that they wanted from other countries and were not able to get. And those countries could begin to put some of that stuff on the table if you broaden the conversation large enough. Well, take that special and differential treatment provision in the WTO, which Brazil has now said they're willing to put on the table or actually give up unilaterally. I'm not sure which, but that's just one of many, and I could list quite a catalog. And so that's my big point, this notion of unilaterally putting to one side these precepts of international taxation, not in a negotiated way, but just because we think that the world has changed, and I agree it has changed, is not appropriate. And the U.S. should retaliate, in my view, if countries or as countries do that. And if I could just cite, I have so many faults I could put on the BEPS study and written about those as well. But the one big one is that they never said who was going to pay. And it's not only a matter of paying at a corporate level as if there's some pot out there in the sky. You have to work it down to the household level. And I would then criticize this latest IMF report because you have these pots of money that people are going to get. Well, we should know who actually pays, so at least the losers know out of whose pocket it comes, and the losers are essentially households.
Okay, we're nearing the end of our time, so let's have that gentleman and then the person at the back. Let's get both questions on the table, please.
I'll keep it brief. Dan Witt, International Tax and Investment Center. And Vitor, I was hoping you would give us a little bit of a further insight into future. Congratulations, Mick. This was a very bold paper, and I know a lot of work into it. It was also a remarkable press release that I think captured the sensitivity and maybe the tepidness of the board to be so bold. So I was wondering, was there an appetite expressed by a consensus of the board to see the IMF play a greater leadership role vis-a-vis these issues with the G20, a space that has been largely occupied by the OECD, might there be some room for some tax thought competition with your leadership? I mean, make no mistake, I believe over the last 10 years, the IMF has evolved as the global think tank on fiscal issues. And number two, might some of this be reflected with your technical assistance and capacity building programs to advance this CIT reform agenda in the lower income countries?
Thank you. And at the back mic, please.
Well, first of all, thank you very much for the excellent debate. My name is Sergio Chaparro from the Center for Economic and Social Rights. My question has to do with the fact that given the importance that corporate taxation has for developing countries and the fact that apparently two of the most considered proposals in the paper are ways of euthanasia of the corporate income tax, what will be like the best possible outcome for developing countries to keep corporate taxation as a key aspect of the tax structure in those countries? Thank you.
Okay, I'm going to go down the line left to right and let my left to right and let people respond to either or both of those questions. So Gary, Mindy, Mick, and Vitor. Gary, you'll pass. Mindy.
So I think I can't speak for the IMF, obviously, but I agree with Dan's questions. I think they're right. And as to the question of what's the right tax for developing countries, I don't think anyone has the perfect answer to that. I read over and over and over how the corporate tax is more important for developing countries, but I do think there's room for more focus on individual tax. I recognize that's hard, but I get curious why that's not a larger part of the conversation. Why it always seems to be corporate tax from multinational taxpayers that are outside the country.
Thank you. Mick?
Actually, I think I'd just like to pick up on Mindy's point, which I think we very much agree with, and I think we try to make it in the paper that there's so much focus on corporate taxation for low-income countries, and it is important, but they have a whole load of other things to do. You know, they've got to get the VAT to work, the personal income tax to work, property taxes. So I think, and we do also, I think, get a little bit frustrated when there are international initiatives and then low-income countries are drawn into the process and expected to divert their best staff into, I don't know, figuring out complying with transparency standards or so on when there's so much else to do. So I think that is a frustration. And equally, I think would be also the answer that I'd give to the question, what is the best system for developing countries? I think we have to, I think we have to see this in the broad spectrum of all the tax problems they face, both policy and administration. And I think, for example, sometimes it can be a little bit of a frustration for us when, it can be the case that G20 and others focus on international tax issues for developing countries, but not wider issues for developing countries. That I think that's where we'd like to see more emphasis, I think, placed. But I think my final thought, actually, I was very struck with Mindy's other remark in her presentation about the consequences of failure. I mean, that's actually rather an interesting question. What happens if all this actually goes belly up and the inclusive framework really doesn't deliver anything? That's food for thought. Thank you. Thank you.
So the process of negotiation, the progress in this process will be driven by the inclusive framework, and the G20 will play a role in mobilizing the necessary political impetus around solutions and approaches that the inclusive framework hopefully will be able to put forward. What do we contribute from the IMF side? We do contribute with quality economic analysis, of which this paper is one example. The 2014 paper is another, and going forward, we will continue making this type of contributions. We do work together with the OECD, the World Bank, and the United Nations in the context of the platform for collaboration on tax. In that context, apart from the toolkits that were already referred to, apart from the very important viewpoint from developing countries that we always insist in that context, we have been able to develop a concept, the medium-term revenue strategy, which is, to our mind, in many cases, in many countries, a very good way for countries to mobilize the necessary commitment to a process of change that will deliver, hopefully at the end, a significant upgrade in their tax capacity. This medium-term revenue strategy is the example of a concept which was possible to agree with the OECD, the World Bank, and the United Nations, and is now being taken over by a number of countries around the world, and we would expect that to deliver results. Indonesia is a very good example, has a fully articulated medium-term revenue strategy, and RUD has a paper with Juan Toro in which they actually explain that very carefully. Now, don't forget that this paper that we put forward with all the strong points that it has, it's very high level. And in taxation, the devil is in the details. So it will be impossible to know how exactly a proposal affects low-income developing countries before one actually sees the details and in particular, in what dimensions will one accept taxation at the source. For example, when it comes to natural resources, it's very easy to identify natural resource rents, and there clearly there is scope to apply the source principle, which has no legal difficulties or difficulties in administration. But I'm not making a general point, I'm making a specific point that when we go to specific negotiations, we're likely to settle for hybrids, where in various dimensions we will go for rough approximations of some nature. And the distributional impacts of the various proposals will depend crucially on what exactly will be agreed in the various dimensions of the tax system.
All right. So with a closing plea to keep the tax lawyers in business working and the legislators of various legislatures, we will call this meeting to a close. Thank you all for joining us. Thanks to the IMF and both the Public Affairs and Fiscal Affairs departments for their continued partnership. Thanks to Gary and Mindy for leaving more salutary places to come comment here today. And thanks to Vitor and especially to Michael Keene for the presentation of the team's great work.